Hello and welcome back once again. This is your host Harshit Sinha, continuing from my previous presentation. Today I will discuss about available options for sustainable investment in India. Sustainable investment practices are increasingly being adopted by investors looking to align financial returns with positive social and environmental impact. The Global Sustainable Investment Review highlights that India's sustainable investment market is evolving, driven by growing awareness among the investors about the importance of sustainability and corporate responsibility, shedding lights on the India's position within its bargaining market. Sustainable investing, which integrates environmental, social, and governance factors into investment decision, has been gaining traction worldwide, and India is no exception. Key trends in India include the implementation of norm-based screening, negative or exclusionary screening, positive or best-in-class screening, and corporate engagement through shareholder action. These strategies aim to promote responsible investment practice and mitigate risk associated with ESG factors as largely discussed in my previous presentation. Looking ahead, the future of sustainable investment in India appears promising with increasing integration of ESG factors into investment strategies and a growing number of initiatives aimed to promoting sustainable finance. As global awareness of sustainability issues continue to rise, India stands poised to play a significant role in shaping the future of sustainable investing. Further, India also emphasized the role of impact or community investing in India, where investment are directed towards projects that generate measurable social or environmental benefits alongside financial returns. This approach not only addresses pressing societal issues but also contributes to sustainable development goals. This presentation serves India's current status in sustainable investment, showcasing its potential to contribute positively to both financial market and societal well-being through responsible investment practice. Now we shall discuss norm-based screening as per national standards. The Security and Exchange Board of India (SEBI) has taken significant steps to integrate environmental, social, and governance consideration into the Indian financial market. Recognizing the importance of sustainable investing, SEBI has introduced a series of norms aimed to promoting transparency, accountability, and responsible investment practice. First is disclosure requirement. SEBI has mandated enhanced disclosure requirement for listed companies focusing on ESG related information. Companies are required to publish business responsibility and sustainability report, that is BRSR, as a part of their annual reports. These reports provide detailed insight into the company's ESG performance, including environmental impact, social responsibility, and the governance practice. The BRSR framework aligns with the global standards and includes matrices on greenhouse gas emissions, water usage, waste management, employee welfare, and corporate governance. The second important part is ESG rating agency. To ensure the credible and standardized assessment of ESG performance, SEBI has recognized the role of ESG rating agency. These agencies evaluate companies based on the variety of ESG criteria and provide ratings that help investors make informed decisions. SEBI's guidelines ensure that these ratings are transparent, consistent, and based on the robust methodologies. This move enhances the reliability of ESG data and promote trust among the investors. Next is related toward the stewardship code. SEBI has introduced stewardship code for institutional investors, including mutual funds and insurance companies. This code encourages the institutional investors to engage actively with the investee companies on ESG issues. It outlines principles for responsible stewardship, including monitoring ESG performance, engaging in dialogues with the company's management, and voting on shareholder resolution. The Stewardship Code aims to promote long-term value creation and sustainable growth. The next is most important is the introduction of the green bonds. SEBI has also established guidelines for the issuance of the green bonds, which are used to finance projects with environmental benefits. These guidelines specify the criteria for eligible projects such as renewable energy, energy efficiency, pollution prevention, and sustainable water management. Issuers are required to provide transparency on the use of proceeds and impact reporting, ensuring that funds are used effectively for the green initiatives. Overall, SEBI norms for sustainable investment strategy reflects a comprehensive approach to integrating ESG consideration into Indian financial market. By enhancing disclosure requirement, recognizing ESG rating agency, introducing the Stewardship Code, and establishing guidelines for green bonds, SEBI aims to foster a culture of sustainability and responsible investing. These measures not only align Indian markets with the global best practices but also contribute to the broader goals of sustainable development and long-term value creation. Now we shall discuss what are the options available for sustainable investment strategies. Sustainable investment strategies are increasingly gaining prominence in India as investors seek to align financial goals with environmental, social, and governance, that is ESG considerations. Three key strategies are pivotal in this landscape as discussing now. The first is the negative or exclusionary screening. This strategy involves excluding investments in companies or sectors that do not meet specific ESG criteria. In India, investors may choose to avoid industry involved in activities such as fossil fuels, tobacco, or weapon manufacturing, thereby promoting ethical investment practice. Next is positive or the best in class screening. This approach identifies and invests in companies that demonstrate leading ESG practices within their respective industries. By selecting companies with robust sustainability initiative and responsible governance structure, investors can support business committed to long-term sustainability. The next is norm-based screening. Norm-based screening involves adhering to international norms and standards such as those set by the United Nations Global Compact or the OECD guidelines and the multinational enterprises. This ensures that the investment align with the globally accepted principles of human rights, labor standards, environmental protection, and anti-corruption measures. These strategies not only mitigate investment risk associated with ESG factors but also contribute to fostering sustainable development in India. By integrating these screening methods into their investment decision, investors can drive positive change while seeking financial returns. In conclusion, as India continues to embrace sustainable finance, these strategies play a crucial role in shaping a resilient and responsible investment landscape that supports both economic growth and societal well-being. Now we shall discuss what are the Indian sustainable investment market. The Indian sustainable investment market has been experiencing significant growth in recent years, reflecting a global trend towards responsible investing. This growth is driven by increasing awareness of environmental, social, and governance issues among the investors and regulatory push for the sustainable business practice. The first is market size and growth rate. As of 2020, the size of Indian sustainability investment market was estimated to $38.2 billion according to the report of Global Sustainable Investment Alliance. This represents a growth rate of approximately 26% from 2018 to 2020. While the growth is impressive, sustainable investments still account for only a small fraction of India's total assets under management, including significant room for expansion. The strategy used: Indian investors are employing five major sustainable investment strategies that largely supported SEBI, which are as follows. ESG integration. This is the most widely used strategy where the ESG factors are systematically incorporated into investment analysis and decisions. Negative exclusionary screening. Investors exclude companies or sectors involved in controversial activities like tobacco or weapon manufacturing. Next is related to the corporate engagement and the shareholder action. Investors use their shareholder rights to influence the corporate behavior on the ESG issue. Next is sustainability themed investing, focusing on a specific theme like renewable energy, water management, or sustainable agriculture. Next is related to the impact investing, that is aiming to generate measurable social and environmental impact alongside financial return. However, while the market is growing, challenges remain, including a lack of standardization, ESG data, and limited awareness among the retail investor. To some extent, India has done the standardization. However, as regulatory support strengthens and awareness grows, India's sustainable investment market is poised for substantial expansion, offering significant opportunities for investors looking to combine financial returns with positive impact. Now we shall discuss drivers of sustainable investment. Sustainable investment has gained significant momentum globally, driven by a combination of regulatory pressure, evolving investors' demand, and the need for better risk management. These drivers are reshaping the investment landscape, pushing both companies and investors to integrate environmental, social, and governance factors into their decision making. The first is related to regulatory drivers. The government and regulatory bodies worldwide are increasingly mandating ESG disclosure and sustainable business practice. In the European Union, the Sustainable Finance Disclosure Regulation, that is SFDR, require financial market participation to disclose how they consider sustainability risk. Similarly, the Security and Exchange Board of India has introduced business responsibility and sustainability reporting for the top 1,000 listed companies. These regulation aims to improve transparency and comparability in sustainable investment, driving capital towards more sustainable business. The next is related to investor demands. Investors, particularly millennials and Gen Z, are increasingly demanding that their investments align with their values. A 2021 survey by Morgan & Stanley found that 79% of individual investors were interested in sustainable investing, up from 71% in 2019. Institutional investors are also driving these trends, with many large pension funds and asset managers committing to net zero portfolio by 2050. This shift in investors' preference is compelling companies to improve their ESG performance to attract and retain investments. The next is related to managing the risk. Sustainable investment is increasingly seen as a crucial risk management tool. ESG factor can pose significant risk to the company's operations and the financial performance. For instance, climate change can lead to physical risk, example damage to asset from extreme weather events, and transition risk, that is policy changes affecting carbon initiative industries. By considering ESG factors, investors can better assess and mitigate these risks. A meta study by NUY STEM Center for Sustainable Business found that ESG investing provided downside protection, especially during social and economic crisis. The conversion of these drivers is creating a powerful momentum for sustainable investment. As the regulatory pressure increases, investor demand evolves that the link between ESG performance and risk management become clear. Sustainable investment is likely to become mainstream. This shift presents both challenges and opportunities for investors and companies alike, requiring fundamental rethinking of investment strategies and business model. Now we shall discuss about the institutional investors. India's financial landscape has been evolving rapidly, with the institutional investors playing an increasingly significant role. Among these, banks, insurance companies, and pension funds stands out as a key player shaping the country's investment environment. Banks, Indian banks, both public and private, are major institutional investors. They invest in government securities, corporate bonds, and equities, balancing regulatory requirement with return objective. As of March 21, scheduled commercial banks in India held investments worth of rupees 44.98 trillion, with a significant portion in the government securities. Banks like State Bank of India and ICICI Bank have sustained investment portfolio. SBI, for instance, had investment books of rupees 13.8.5 trillion as of March 2021. Next is insurance companies. Insurance companies in India are substantial institutional investors with life insurers particularly active due to their long-term liabilities. The Life Insurance Corporation of India, that is LIC, the country's largest insurer, is also one of its biggest institutional investors. As of March 2021, LIC total assets under management stood at rupees 37.46 trillion. Insurance Regulatory and Development Authority of India, that is IRDA, regulates insurers' investment pattern, ensuring a balance between safety and return. The next is pension fund. The pension funds in India, though smaller compared to the developed market, are growing rapidly. The National Pension System, that is NPS, managed by the Pension Fund Regulatory and Development Authority, that is PFRDA, has significant growth. As of March 2021, the total asset under management under NPS stood at rupees 5.78 trillion. The Employee Provident Fund Organization, that is EPFO, another major pension fund, has investment corpus of 15.76 trillion as of March 2021. These institutional investors significantly influence India's capital market. Their investment decision can move market indices and affect corporate governance practice. In recent years, there has been a growing focus on the sustainable investing among the Indian institutional investors. For instance, SBI Mutual Fund launched India's first ESG fund in 2018, signaling a shift towards responsible investing. Regulatory bodies like the Security and Exchange Board of India, SEBI, have been encouraging greater participation of institutional investors in corporate governance. The introduction of stewardship codes for mutual funds and alternative investment funds is a step in this direction. As India's economy continues to grow and its financial markets mature, the role of institutional investors is expected to become even more crucial. Their investment strategies and priorities will likely play a significant role in shaping India's economic future and the corporate landscape. This slide discusses about the retail investors. The landscape of retail investing in India has undergone a significant transformation in recent years. driven by increasing financial literacy, technological advancement, and regulatory reforms. This presentation explores three key aspects of retail investing in India. The first one is awareness and education. Financial literacy among the Indian retailer investors have been steadily improving thanks to concreted efforts by the regulators, financial institutions, and educational organizations. The Security and Exchange Board of India, that is SEBI, has been at the forefront of investor education initiative conducting workshops, seminars, and online programs. Additionally, the Reserve Bank of India's National Strategy for Financial Education, that is NSFE 2020 to 2025, aims to make every Indian financially empowered through access to formal financial services and basic understanding of financial concept. Despite these efforts, challenges remain. A 2019 survey by the National Center for Financial Education found that only 27% of Indian adults were financially literate. This highlights the need for continued and expanded financial education efforts. The next is related to the product offering. The range of investment products available to Indian retailer investment has expanded significantly. Beyond traditional options like fixed deposit and gold, retail investors now have access to: first is mutual fund with over 2000 schemes available including equity, debt and hybrid fund. Next is direct equity facilitated by discount brokers and mobile trading apps. Another is exchange trade fund, that is ETF, offering low cost exposure to various indices and commodities. Next is related to the government securities through the RBI Retail Direct Scheme launched in 2021. And the last is systematic investment plan, that is SIPs, allowing small regular investments in the mutual funds. The proliferation of fintech platform has democratized access to these products, making investment more accessible to broader segment of population. The next is related to the main factor is transparency and reporting. Regulatory bodies have implemented several measures to enhance the transparency and protect retailer investors. First is related to the SEBI mandate that categorizing and rationalizing of mutual fund scheme in 2017, making it easier for investors to compare products. Next is related the introduction of unified payment interface, that is UPI, for applying in public issues has simplified the IPO application process. Another factor is the SEBI's grievance redressal platform, that is SCORE, SCORES, SEBI's complaint reader systems, provides a centralized system for addressing investors' complaint. Moreover, SEBI has stringent disclosure requirement for listed companies and mutual funds, ensuring that retailers investors have access to timely and accurate information. While the significant progress has been made in empowering retail investors in India, challenges remain, particularly in the areas of financial literacy and investor protection. Continued efforts from regulatory, financial institutions, and educational organizations will be crucial in further developing a robust and inclusive retail investment ecosystem in India. Now we shall discuss about the role of asset managers. Asset managers in India play a crucial role in shaping the investment landscape, with their influence extending beyond mere funds management. This presentation explores three key areas where asset managers are making significant impact. The first is ESG integration. Environmental, social, and governance factors are increasingly becoming central to investment decisions in India. Asset managers are at the forefront of this shift, integrating ESG consideration into their investment process. According to 2021 CRISIL report, ESG asset under management in India grew up by 76% in the fiscal year of 2021, reaching rupees 11,800 crores. Leading assets management companies like SBI Mutual Fund and Axis Mutual Fund have launched ESG focused funds, demonstrating the growing importance of sustainable investing. The Security and Exchange Board of India, that is SEBI, has also mandated ESG disclosure for the top 1000 listed companies, further encouraging asset managers to consider ESG factor in their investment decision. The next is related to product development. Asset managers in India are continuously innovating to meet evolving investors' needs and the market condition. Some key trends in product development include thematic funds, focus on specific sector or theme like technology, healthcare, or consumption. Next is passive funds, offering low-cost index funds and exchange trade funds, that is ETFs. Next is depth fund, developing various categories to cater to different risk appetites and investment horizon. The Association of Mutual Funds in India, that is AMFI, reported that the mutual fund industry's asset under management grew rupees 37.73 lakh crores in 2021, reflecting the success of these product development efforts. Now, the next factor is engagement and stewardship. Asset managers are increasingly taking an active role in corporate governance through engagement and stewardship activities. SEBI's stewardship code for mutual funds and alternative investment funds, introduced in 2020, has formalized this role. Under this code, asset managers are required to formulate a comprehensive policy on discharging stewardship responsibilities, monitor and actively engage with investee companies on the various issues, manage conflicts of interest in fulfilling stewardship responsibilities, and enhancing the transparency in voting and disclosure. For instance, HDFC Mutual Fund reported voting on 716 resolutions across 97 companies in the quarter of ending March 2021, demonstrating active engagement with the investee companies. In conclusion, one could say that the asset managers in India are displaying a multifaceted role going beyond traditional fund management. Through ESG integration, innovative product development, and active engagement with the companies, they are shaping a more responsible, diverse, and transparent investment ecosystem in India. As the market evolves, the role of asset manager is likely to become even more crucial in driving sustainable growth and good corporate governance. This slide discusses about the impact investing. Impact investing in India has gained significant traction in recent years, driven by the country's pressing social and environmental needs coupled with its vast market potential. First, let us discuss about the definition. Impact investing refers to investments made with the intention of generating positive, measurable social and environmental impact alongside the financial return. The Global Impact Investing Network, that is GIIN, define it as the investments made into companies, organizations, and funds with the intention to generate social and environmental impact alongside financial return. Next, we shall discuss about the sectors. In India, impact investments span various sectors including financial inclusion, that is microfinance institutions and fintech companies serving underbanked population. Second is healthcare, affordable healthcare services and medical technology. Next is education, EdTech platform and affordable schools. Next is related to agriculture, that is agri-tech solution and sustainable farming practice. Other is clean energy, that is renewable energy project and energy efficient technology. And the last is related to the water and sanitation, clean water access and waste management solution. According to the report by the Impact Investors Council, the impact investing market in India grew to $10.8 billion between 2010 and 2020 with over 500 active impact enterprises. Next is related to what are the challenges. Despite its growth, impact investing in India faces several challenges. Measuring impact, standardization and quantification of social and environmental impact remain complex. Scale. Many impact enterprises struggle to achieve scale due to limited resource and complex operating environments. Next is related to the talent gap. There is a shortage of skilled professionals who understand both business and social impact. Next is related to regulatory environment. Navigating India's regulatory landscape can be challenging for impact investors and enterprises. And the last is exit option, limited exit option for investors, particularly in non-tech sector, that is non-technical sectors. The Indian government has taken steps to support impact investing, such as establishing the Rs 5,000 crore social impact funds under the National Investments and Infrastructure Fund. However, addressing these challenges will be crucial for the continued growth of the effectiveness of impact investing in India. As the sector evolves, impact investing has the potential to play a significant role in addressing India's development challenges while delivering financial return to the investors. Now we shall discuss one of the most important aspects, that is the green finance. As India strives to meet its ambitious climate goal and transitions to low carbon economy, green finance has emerged as a crucial tool. This presentation explores the current status of green finance in India, focusing on three key areas. The first is related to green bonds. Green bonds have gained significant traction in India since the first issuance by Yes Bank in 2015. The Security and Exchange Board of India, that is SEBI, introduced green bonds regulation in 2017, providing a framework for these instruments. As of 2021, India had become a second largest emerging green bond market after China, with a cumulative issuance of $10.3 billion. Notably, issuance includes the State Bank of India worth of Rs $650 million green bond in 2018, the first by an Indian public sector bank. The second is Indian Railway Finance Corporation reported $500 million green bond in 2017 for financing dedicated freight corridor. Next is related to Green Bank. While the Indian doesn't have the dedicated National Green Bank, several institutions performing similar function. Indian Renewable Energy Development Agency, that is IREDA, a mini Ratna company under the Ministry of New and Renewable Energy, focusing on renewable energy financing. The Tata Clean Tech Capital, a joint venture between the Tata Capital and International Finance Corporation, providing green finance solution. These institutions play a crucial role in channeling funds towards green projects, particularly in the renewable energy sector. The next is related to green funds. Green funds in India have been growing both in number and size. National Investment and Infrastructure Fund launched a renewable energy platform with UK CDC Group targeting 2 gigawatt of capacity. The mutual funds. Several assets management companies have launched ESG and green themed funds such as SBI Magnum Equity ESG Fund and Axis ESG Equity Funds. The other is alternate investment funds, specialized green funds like Eversource Capital's Green Growth Equity Fund, which raised $74 million for green energy investment. Despite this progress, challenges remain: limited domestic investors' base for green bonds, need for standardized definition and reporting framework, high perceived risk in some green sector. However, opportunities are abundant. India's commitment to achieving 450 gigawatt for renewable energy capacity by 2030 and becoming net zero by 2070 will require significant green financing. The green financing landscape in India is evolving rapidly, driven by policy support, market demand, and global climate commitments. As the sector matures, it has the potential to play a pivotal role in India's sustainable development journey. Now we shall discuss about the climate change and sustainable investing. Climate change poses significant challenge and opportunity for sustainable investing in India as the investor increasingly recognizing the financial implications of environmental risk. They are integrating climate consideration into their investment strategy. This approach addresses the physical risk, transition risk, and the new opportunity available in the market. Let us discuss one by one. The first is physical risk. Physical risks from climate change, such as extreme weather events, rising sea level, and temperature fluctuation, can have profound impact on business and economies. In India, sectors like agriculture, infrastructure, and real estate are particularly vulnerable. Sustainable investors are increasingly factoring these risks into their investment decision by assessing companies' resilience and adaptation strategies. Investment in business with robust climate risk management practice are prioritized, as these companies are better positioned to withstand and recover from the climate-related disruption. The next is related to transition risk. The transition risk arises from the shift towards the low carbon economy. As India progresses towards the climate goals, including commitment under the Paris Agreement, regulatory changes, technology advancement, and the market shift are expected. Companies that are heavily reliant on fossil fuels or those with a significant carbon footprints may face financial risk as they adapt to new regulation and market conditions. Sustainable investors are focusing on companies that are proactively reducing their carbon emission and investing in clean technology by supporting that are ahead of the curve in the transition to a sustainable economy. Investors can mitigate transition risk and drive positive environmental outcome. For example, as India moves towards a low carbon economy, certain sectors faces transition risk. Now comes what are the opportunities available. Despite the risk, climate change also presents numerous opportunities for sustainable investing in India. The transition to green economy opens up investment prospects in renewable energy, energy efficiency, sustainable agriculture, and green infrastructure. India's ambitious renewable energy target and government incentives for clean energy projects create a favorable environment for investment in solar, wind, and hydroelectricity power. Moreover, innovation in sustainable technologies and practices offer new avenue for growth and profitable investors. Investors who are capitalized on these opportunities can benefit from long-term value creation while contributing to climate resilience and sustainability. Overall, it seems that as climate changes continue to shape the global economic landscape, sustainable investing in India presents both challenges and opportunities. Investors who can effectively navigate the physical transition risk while capitalizing on emerging opportunities are likely to benefit in the long term. Moreover, sustainable investing has the potential to play a crucial role in India's transition to low carbon, climate resilient economy. In conclusion, climate change presents both risk and opportunity for sustainable investing in India. By addressing physical and transition risks and sizing emerging opportunities, investors can play a crucial role in fostering a resilient and sustainable future. Now we shall discuss about the fiduciary duty and ESG integration. Fiduciary duty in context to investment management refers to the obligation of financial professionals to act in the best interest of their clients. Traditionally, this duty has focused on maximum or maximizing the financial returns. However, in recent years, the concept has expanded to include the integration of environmental, social, and governance factor into the investment decision, recognizing that ESG considerations are material to long-term financial performance. Let us start. What is fiduciary duty? What is the definition of it? Fiduciary duty involves a legal and ethical obligation to prioritize clients' interests above all else, ensuring prudent management of their assets. This includes conducting a thorough due diligence, mitigating risk, and seeking optimal returns. In context to ESG integration, fiduciaries must consider how ESG factors impact the sustainability and profitability of their investments. Ignoring these factors could lead to suboptimal investment outcomes and potential legal liabilities. The next is related to ESG integration. Integrating ESG factor into investment decision involves assessing the sustainability practice and governance structure of potential investments. This approach goes beyond traditional financial analysis to include evaluation of environmental impact, social responsibility, and corporate governance. For instance, investors may examine a company's carbon footprints, labor practice, and the board diversity. In India, ESG integration is becoming more prevalent as investors recognizing its importance in managing risk and identifying opportunity. Asset managers and the financial institutions are increasingly adopting ESG framework to ensure their portfolio are resilient and aligned with the long-term sustainable goals. Another factor is the regulatory guidance. In India, regulatory bodies are providing guidance to encourage the integration of ESG factors into fiduciary duties. The Securities and Exchange Board of India (SEBI) has introduced regulation requiring listed companies to disclose their ESG practice, enhancing transparency and accountability. SEBI's Business Responsibility and Sustainability Reporting, that is BRSR framework, mandates detailed ESG disclosure, enabling investors to make informed decisions based on the standardized and comparable data. This regulatory support is crucial in promoting ESG integration and ensuring that fiduciary meets their obligation in comprehensive and forward-looking manner. The concept of fiduciary duty in India is evolving to encompasses ESG consideration driven by regulatory initiatives and the growing awareness of the impact of the ESG factors on the long-term value creation. As this field continues to develop, it is likely to play an increasingly important role in shaping investment practice and corporate behavior in India. In conclusion, fiduciary duty in India now encompasses the integration of ESG factors, reflecting a broader understanding of what it means to act in the best interest of clients. As regulatory guidance evolves, the incorporation of ESG consideration into investment practice is becoming a standard expectation, ensuring that fiduciaries contributes to the sustainable and responsible financial markets. Now we shall discuss sustainable investment trends. Sustainable investing in India is witnessing remarkable growth, driven by increasing awareness of environmental, social, and governance issues and collective shifts toward the responsible finance. Key trends shaping the dynamic landscape includes the growth in sustainable investment asset, the expansion of ESG integration, and the emergence of a new investment strategies. Let us look one by one the growth in sustainable investment assets. Over the past years, the volume of assets under management in sustainable investments in India has surged significantly. Investors are increasingly recognizing the financial materiality of ESG factors and their impact on long term value creation. According to the recent report, the Indian sustainable investment market is growing at a rapid pace, reflecting a broader global trend. This growth is driven by the combination of institutional and retail investors seeking to align their portfolio with their values and the principle of responsible investing. The sustainable investment market in India has seen remarkable growth over the past decade. According to the report by the Impact Investor Council, the impact investing market in India grew to $10.8 billion between 2010 to 2020, with over 500 active impact enterprises. This growth is further evidenced by the increasing number of ESG themed mutual fund and exchange trade fund, that is ETF, in the country. As of 2021, there were over 10 ESG mutual funds in India with asset under management exceeding 12,000 crore rupees. The key developments in this regards is as follows, that is expansion of ESG integration. ESG integration is becoming standard practice among Indian assets manager and financial institutions. This involves incorporating ESG criteria into investment analysis and decision-making process to identify risk and opportunity that traditionally financial matrices might overlook. Companies with a strong ESG performance are perceived as a better position to manage risk, size opportunities, and achieve sustainable growth. The increased availability of ESG data and the rating has facilitated this integration, enabling investors to make more informed and responsible investing choice. In this regard, the corporate adoption. Many large Indian corporates are voluntarily adopting ESG reporting standards and integrating sustainability into their business strategy. Other is investors' demand. Institutional investors, particularly foreign investors, are increasingly demanding ESG consideration in their investment decision. Next is about related to rating agency. The emergence of ESG rating agency and indices specific to the Indian market, such as the S&P, BSE, 100 ESG index, etc. The third factor is the emergence of new investment strategies. As the sustainable investment landscape evolves, new strategies are emerging to cater to diverse investors' preference. Impact investing, which aims to generate measurable social and environmental benefit alongside the financial return, is gaining traction. Green bond, which finance environmentally friendly projects, are also becoming popular. Additionally, thematic investing focusing on areas such as renewable energy, sustainable agriculture, and clean technology is attracting significant interest. These innovative strategies provide investors with a broader range of options to achieve their financial and sustainable goals. The first is related to the green bond. India has become the second largest emerging green bond market after China, with a cumulative issuance of $10.3 billion as of 2020. The second option is blended finance, combining public and private capital to finance sustainable development projects, particularly in sectors like renewable energy and affordable housing. Next is related to sustainability-linked loans, loans with the interest rate tied to the borrower's achievement of the specific sustainability target. And the last one we can say is the social impact bonds, pay for success instrument that tie financial returns to measurable social outcomes. In conclusion, the sustainable investment landscape in India is characterized by robust growth in assets, widespread ESG integration, and the development of innovative investment strategies. These trends reflect a broader commitment to fostering a sustainable and responsible financial ecosystem, positioning India as a significant player in the global sustainable financial movement. Now, let us see what are the challenges and the opportunities available in India related to the sustainable finance. Sustainable investment in India faces challenges including limited awareness among the investors. Many lack understanding of environmental, social, and governance criteria and their impact on the long term returns. However, opportunities abound. Increasing investor education campaign can bridge the knowledge gap. The growing millennial investors base shows heightened interest in sustainable options. Government initiatives like Green Bond and creating a supportive ecosystem. As climate risks become more apparent, companies adopting sustainable practice may see improved financial performance. With the proper education and the policy support, India's sustainable investment market has significant growth potential, offering both financial returns and the positive societal impact. Sustainable investment in India faces significant challenge, primarily the lack of standardized environmental, social, and governance data. This inconsistency makes it difficult for investors to compare companies and make informed decisions. However, these challenges present opportunities. Developing standardized framework for ESG reporting can enhance transparency and reliability. India's Security and Exchange Board SEBI is taking steps to mandate ESG disclosure for the top companies. This push for standardization can attract more global investors seeking sustainable options as companies improve their ESG reporting practice. It could lead to a better risk management and long-term value creation. Ultimately, standardization ESG data can drive sustainable investment growth in India. Sustainable investment in India faces a significant challenge in short-term investment horizon. Many investors prioritize quick returns, overlooking the long-term benefits of the sustainable practice. This short-termism can hinder the growth of sustainable investment, which often yield returns over extended period. However, this challenge presents the opportunities. Encouraging long-term sustainable investing strategy can lead to more stable return and reduce risk. Finance institution can develop products that incentivize patent capital. Education incentives can highlight the long-term value creation of sustainable investment as more investors recognize the importance of sustainability for long-term financial performance. It could drive a shift towards more sustainable investment practice in India. Sustainable investment in India faces another challenge due to the regulatory and the policy gap. The lack of comprehensive guidelines and incentives can deter investors and companies from prioritizing sustainability. However, these gaps also present opportunities. Strengthening regulatory support and policy framework can significantly boost sustainable investments. The Security and Exchange Board of India (SEBI) has taken steps by introducing business responsibility and sustainability reporting. Further, opportunity lies in developing green taxonomies aligned with the global standards and creating physical incentives for sustainable projects. Enhanced policy support can attract more capital, promote innovations, and accelerate India's transition to sustainable economy. As regulation evolves, it could position India as a leader in sustainable finance in future. Now, this is the last slide of this presentation. We will discuss the key takeaway in summarized manner. The status of sustainability investment in India has evolved significantly and encompasses various critical aspects. First is norm-based screening with a national standard ensures that investment aligns with the ethical and national regulation promoting responsible investing. Sustainable investment strategies are now integral to the Indian sustainable investment market, encouraging the incorporation of the environmental, social, and governance factor. The key drivers of sustainable investment include increased awareness among the institutional and the retailer investor, with asset managers playing a pivotal role in integrating the ESG consideration. Impact investing is gaining traction, target investments with measurable social and environmental impact. Green finance is a crucial in addressing climate change through sustainable investing, with the fiduciary duty and ESG integration underscore the legal and ethical responsibility of financial management. The sustainable investment trends for India reveals both challenge and opportunities, highlighting the sector's dynamic nature. So stay tuned for the next week topic. Explore asset under management for India, where we will dwell deeper in asset management. Until then, wishing you all healthy and safe life.